I'm in a bit of a quandary here. We're in a pretty decent moment for stocks. This is one of the lightest periods for earnings, something I know in my bones because I set aside time every morning to go over the key conference calls. And today, the only one I had to focus on was Oracle, which rarely has any serious pin action. For the rest of tech, that is. No major earnings reports means no major blowups. We don't have much news either for the macro front. Surely we had a slightly hotter than expected consumer price index figure this morning, but nothing that would scare Jay Powell away from cutting interest rates at the next Fed meeting. Honestly, I think Powell's in a tough position. Yes, he raised rates way too fast. That was a mistake. It was a big mistake. But it's not like the economy's exhausted, and he's being labeled a bonehead by President Trump, which is the kind of thing you'd expect to hear from someone like me. But I'm not the president of the United States. We had some movement on the trade talks, but you know where I stand on this issue. I doubt to be anything meaningful here one way or another this soon. I understand there to be no truth to the story floated today of an interim trade deal that things aren't, no, but let's put it this way, things aren't as ugly as they've been. Maybe that's pretty, let's say, sanguine. So there aren't a lot of landmines here. In theory, I should feel pretty darn good about the stock market. Yet there's one thing I'm truly worried about, and it's a big thing. I'm talking about the Standard & Poor's proprietary short-range oscillator, the one I've subscribed to for 30 years, because it gives you the best reading on whether the market is getting overbought, meaning there's too much enthusiasm, or oversold, meaning there's too much pessimism. And right now, the oscillator says, be careful, be very careful, because as of last night, it stands at 8. And that's not just overbought, it's way overbought. Normally, my discipline says you take profits when the oscillator goes above 5. Seeing it at 8 makes me very nervous. Now, maybe my concerns will prove to be way off base. The last time we were this overbought was when Jay Powell changed course, and suddenly we were no longer fighting the Fed. So it made perfect sense for stocks to roar higher. The market just wouldn't quit, but that was for good reason. Historically, though, I haven't made such money, much money to speak of buying stocks when the oscillator's at 8. In the same way, I haven't made much money selling stocks when it's at -8. That's a classic sign we're extremely oversold. At these levels, the buyers usually run out of ammo, just as the sellers get exhausted when they go down too far too fast. So as I said in my ActionAlertsPlus.com club call this morning over at TheStreet.com, if you have some gains here, you got my permission to ring the register. Take something off the table. Buy it back later, lower. It's the responsible thing to do. Of course, some of you probably think I'm being plain old superstitious. I mean, hey, think about this. Does Warren Buffett look at an oscillator? But I think that's the wrong way to look at it. Buffett is a buy and hold guy. If he buys a stock and it goes down, so he can afford to take a very long-term perspective. When you're as rich as Buffett, you can stay solvent for longer than the market can stay wrong. For the rest of us, it makes sense to try to get the best cost basis. That's why I think this is a bad time to buy. When the market gets this overbought, we tend to get a really violent pullback on any negative news. Granted, I don't know where that bad news is going to come from. This is the toughest thing about following my discipline when it comes to this darn oscillator. I have no idea what might go wrong. I just know that until we work off this overbought reading, there's a serious risk of being blindsided. So if you're thinking about starting a position in stock, contributing money for your IRA 401k to an S&P fund, I'm saying it may make sense. Just wait this one out a little. The oscillator is rarely wrong, and it's telling me you're likely to get a better entry point. When in doubt, remember, discipline always trumps conviction. And right now, my discipline says, don't buy, don't buy. Nick in Arizona. Nick!
Professor Cramer, how are you?
I am well, thank you. How about you, Nick?
I'm good. And I absolutely love the show and wanted to thank you for teaching me how to teach myself more about investing.
You're terrific. That is my goal. I try to teach every night here. This is my classroom. Thank you.
Oh, thank you. And I have a two-parter on Snap-on Tools, ticker symbol SNA.
Okay.
So I've owned Snap-on for about a year. Love the company. They have their best-in-class reputation, great management, a good balance sheet, and a healthy dividend that's been steadily growing. So first, do you think Snap-on's a good long-term investment at this level? And second, because of how diversified Snap-on is across so many industries, from auto to defense to tech, all over the world, including the PRC, do you think this stock's worthy of being sort of a barometer stock like the transports?
I think it used to be a great growth stock, and I think it's been very choppy of late. And that's because I think that maybe some of their prices are too high. There's a little more competition. But most importantly, there's a lot of short sellers in it. And every time Nick Pinchuk says something good, they interpret it negatively. So what I would call it is a tough own. And I've got to tell you, Nick, one of my things that I teach people is that a tough own is too difficult to own. Mark in Pennsylvania. Mark.
Hey, Jim, I have a question.
Sure.
I've been saving a large sum of money to start my entry into trading. But with the recession scare looming, the China trade war going on, and the 2020 election ahead, should I start investing now with this sum of money, wait till the new year is over, or wait until this all blows over?
No, look, I don't think we're going to have a recession. I think you just wait till the market goes down, say 3, 4, or 5%. We're too close to the all-time high. We're way too overbought. And while it looks like it's a very good time to buy, I think this last 5 days have made a lot of people pretty darn complacent. All right, so listen up. We're overbought right now, so think twice before buying, because any negative news could turn into a violent pullback. Don't buy. There's much more Mad Money ahead. It offers value-conscious products with a socially conscious message. But can private player Everlane withstand a tough retail environment? I'm going to sit down with the CEO at its brand new Brooklyn outpost to find out. Then, does your portfolio have what it takes to succeed in this market? I'll be the judge of that when we play MI Diversified. And know your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer.
Tomorrow, kick off the trading day with Squawk on the Street. Live from Post 9 at the NYSE.
David, do you know your house, your apartment?
Excuse me?
Your apartment.
Yes,
that
what
you
about
have?
it?
This is an apartment.
It's an apartment.
And you think Senator Warren shouldn't tax more? I'm wearing an apartment.
It all starts at 9 a.m. Eastern. Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.